week, the central bank maintained its CBR rate or benchmark rate at 9%. Now, the signal sent to those lending money is that please lend more to the private sector. Question is, are the lenders reading the same signal from the central bank? That's the focus of our next segment.
For most part of last year and a part of this year, a combination of low demand and resultant depressed economic growth numbers cast a dampened picture in the country's growth projections. By the start of the year, the private sector was seething with exhaustion, not only over lost businesses due to poor market demand and a general weak economic activity, but also the lost billions in properties attached to commercial banks over failure to service loans. As a result, even as the central bank aggressively brought its benchmark rate, which signaled to lenders to bring down credit rates, earlier this year, the private sector seems to have kept away from the banking halls. At 9%, the central bank rate is today at one of its lowest points in years.
The need to contribute to attaining sustainable economic growth. The Bank of Uganda believes that a neutral monetary policy stance is warranted. The Bank of Uganda will therefore maintain the central bank rate, CBR, at 9%. Consequently, the rediscount rate and the bank rate have been set at 13% and 14% respectively.
This, however, is one way of looking at economic growth and stabilization support. The business community feels that wider interventions are necessary, including reducing government security yields, which continue to crowd out the private sector as banks opt to lend more to government as opposed to the business community.
So the banks now have to make a decision between lending to government, which is almost risk-free, and lending to the private sector, which has got inherent risks in those loans and advances.
So on average, the increase in the private sector credit is around 1 trillion, but the government domestic borrowing is 1.8 trillion. So automatically, the new money for government is much higher than the new credit extension to the private sector, and it gives a more attractive yield of 14 plus. Then why should you lend it to a private sector who is risky, and then you still want to borrow at 17.7%?
The central bank also maintains that other wider interventions are necessary, and policy developments like mobile money tax do not seem to support this stance.
Is that there seems to have been some negative impact on mobile money transactions, but we still need time to study this.
Recent developments like the social media tax have also not helped matters and is already being viewed as a potent inflation driver going forward.
That what we saw in July is not necessarily a reflection of inflation persistency. I think the governor's statement was very clear that there are some one-off impacts we saw in July coming from OTT taxes and also taxes on fuel. Remember that the inflation for communication subsector at all in the CPI basket shot up by around 20% in the month of July.
Faced with both internal and external challenging realities, Uganda's economy has for most of late appeared to be swimming against the tide. The move by the central bank, however, gives a good signal that there is interest in seeing private sector credit expansion for wider growth.